Bismillahirrahmanirrahim. This is the third video on fraud, internal control, and cash. In this video, we will discuss how to enhance cash control features by leveraging bank services. We will talk about bank reconciliation statement, reporting cash, managing and monitoring cash, and finally, petty cash and its operations. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. Using a bank for company finances is vital for fraud prevention and cash control. Depositing funds in a bank reduces physical cash on site, lowering the chance of theft. Banks issue statements detailing all transactions, enabling regular monitoring for unusual activities that could indicate fraud. Banks separate custody and record keeping rules, reducing the risk of internal manipulation for personal gain. Bank records provide a transparent history of transactions, making it easier to detect and deter fraudulent activities. Regularly comparing company and bank records help spot errors or unauthorized transactions promptly. Online banking features like transaction alerts offer real time monitoring, adding an extra layer of fraud detection. In short, using a bank enhances cash control and reduces fraud risk through transparency, role separation, and thorough monitoring. So, using a bank for company transactions offers several control benefits like reduced cash handling. The company keeps less physical cash on hand, enhancing security. Double record keeping, that is, both the company and the bank maintain transaction records, aiding in cash control. A very important component is bank reconciliation. That is, it ensures alignment between the company's cash account and the bank's liability account, allowing for easy comparison and verification of transactions. Bank statements provide crucial information from the bank's viewpoint. Debits, these reduce the account balance, including payments like checks. Credit, that is, increase the balances, such as deposits by the company. Daily balances, it shows the account balance after each day's transactions. So each deposit received by the bank increases its liability to the depositor, while each check funded by the bank decreases the liability. Reconciling the bank account is necessary because the bank's and the company's records of the checking account often differ due to two main reasons. One is time lag, that is, transactions may not be recorded by one party in the same period. For instance, delays between writing a check and the bank processing it, a gap between when the company records receipts and when the bank does, time lags in the bank sending transaction memos to the company, and recording errors, that is, mistakes in recording transactions by either the company or the bank. So, while bank errors are rare, the frequency of errors depends on the effectiveness of internal controls maintained by both parties. To reconcile the bank account, follow these steps. Compare deposits. Match individual deposits on the bank statement with deposits in transit from the previous reconciliation and with company records. Any deposits recorded by the company but not by the bank are added to the bank balance. So compare deposits on the bank statement with company records. Add any deposits not yet recorded by the bank. Then checks paid. Compare paid checks on the bank statement with outstanding checks from the previous reconciliation and with company records. Any checks issued by the company but not paid by the bank are subtracted from the bank balance. So compare paid checks on the bank statement with company records. Subtract any checks issued but not yet processed by the bank. Then identify errors. Any error found in the previous step should be corrected. Errors by the company affect the adjusted cash balance per books, while errors by the bank affect the adjusted cash balance per books. Review bank memoranda, that is, match bank memoranda with company records. Any unrecorded memoranda should be listed for further review. So, bank records with company records. So, sorry, match bank records with company records and list any unrecorded items. Following these steps help ensure accurate reconciliation between the balance per bank statement and the balance per books. It is best for this task to be handled by an employee with no other related responsibilities. Let us look into an illustration. Presented below is the bank statement for Layard Company. It shows a balance per bank. And on this date, the balance for cash per books is 11,589. From the foregoing steps, Layard determined the following reconciling items. There is deposit in transit, there are outstanding checks, there is an error in a check, there is a bank memoranda, deposits not sufficient fund, and there are printing charges charged by the bank. There is collection as well. So we have to prepare a bank reconciliation. So we will follow the same chart that I have explained you just now, and in the process we are going to see how the things move. So first of all, let us look into the cash balance as per the bank, and cash balance as per the bank is 15,907.45. Then there is a deposit in transit, and the deposit in transit is 2,201.4. This is going to be added, so the total will be 18,108.85. Then there are outstanding checks, and these checks are to be subtracted. You can see we have outstanding checks of 3,000, 1,401 and 1,502.7. That makes 5,904 and point 0, and this will be subtracted. This is equal to 12,204.85. So after reconciliation, the actual bank balance is 12,204 and not 15,907 as stated in the illustration. Next, we prepare the uh, bank reconciliation as per the balance in the books, and we can see that in the books the cash balance is 11,589.45, and to this we are going to add the error in recording the check number 443. You can see it was written correctly 1206. It was paid also correctly by the bank, but the light company has recorded the check as 1262. So that means that there is a difference of 36 over here, and this error in the recording has to be added. So that is going to be error in the check. This is equal to, this will be added, and the amount to be added is 36. Error in the check. Then there is a debit note of not sufficient funds from J.R. Barron for 4,425. So this must be subtracted, 425.60. At the same time, there is a debit of printing company check charge of 30 by the bank. So this is also going to be subtracted. And then finally, there is a collection of note receivable of 1000 plus interest earned 50. So 1000 plus 50, that makes 1050, and we are going to subtract the bank collection fees of 15. So the balance is 1035, and this will be added. 1035. So this will be added. So now we have 11,589, then we have 1035, and we have 36. These two are going to be added, and 425 will be subtracted, and bank service charges will be subtracted, and the net amount is now 12,204.85. And now we can see that the cash balance as per the bank statement and as per the books are the same. Okay. Uh, now, recording reconciling items is crucial for maintaining an accurate cash account balance, and if these items are not logged, the cash balance won't be correct. So we can see that the cash has increased by 1035, and then there were miscellaneous expenses of 15, and we have decrease in our notes receivable by 1000, and our there is a revenue earned of 50 as well. So that's how you can see that cash is debit by 1035, miscellaneous expense are debit by 15, note receivables are credit by 1000, and the another thing was to have the revenue over here of 50, sorry, interest earned, interest revenue of 50. So that's how we make this general entry. Another entry that we can see will be related to the error that was made in recording the transaction number 443, and for this cash is going to be debit by 36, and accounts payable is credit by 36 again. Then another component is regarding the not sufficient funds, and for not sufficient funds, there was accounts not sufficient fund of 425.6, and this has to be recorded again. So accounts receivable is debit and cash is credit to record non sufficient funds. Finally, the bank has charged $30 for printing the checks, and so there is a miscellaneous expense. So miscellaneous expense is debit and cash is credit. Now we prepare the cash account, and if you can recall, the cash balance as per the books was 11,589. Then we have received cash of 1,035, and at the same time there was an error in recording the check, so cash was debit by 36. At the same time there was not sufficient fund of 425, and the bank has charged $30 for the printing of $30 for bank charges that they have charged. Uh, they have charged $30 over here. So that's how we record all these transactions. This 36 is the error in recording the check number 443 that we have already recorded. 36 over here. Okay. Now, electronic fund transfer (EFT) is a method of transferring funds without paper like checks or deposit tickets. Instead, it uses wire, telephone, telegraph, or computer to move cash from one place to another. Now, no recent fraud has. Let us look into a case by Madoff Ponzi scheme. Now, no recent fraud has generated more interest and rage than the one perpetrated by Bernard Madoff. Madoff was an elite New York investment fund manager who was highly regarded by securities regulators. Investors flocked to him because he delivered steady returns of between 10 to 15%, no matter whether the market was going up or going down. However, for many years, Madoff did not actually invest the cash that people gave to him. Instead, he was running a Ponzi scheme. He paid returns to existing investors using cash received from new investors. As long as the size of this investment fund continued to grow from new investments at a rate that exceeded the amounts that he needed to pay out in returns, Madoff was able to operate his fraud smoothly. To conceal his misdeeds, he fabricated false statements that were provided to investors. In addition, Madoff hired an auditor that never verified the accuracy of the investment records but automatically issued unqualified opinions each year. The competing fund manager warned the SEC a number of times over a nearly 10 years period that he thought Madoff was engaged in fraud. The SEC never aggressively investigated the allegations. Investors, many of which were charitable organizations, lost more than 18 billion. Madoff was sentenced to jail terms of 150 years. So, how was Madoff able to conceal such a giant fraud? So, we can see that Madoff made up fake investment statements for investors. His auditor didn't check these statements but still gave Madoff a positive opinion every year. Okay, Sally Kist owns Linen Kist Fabrics. Sally asks you to explain how she should treat the following reconciling items when reconciling the company's bank account: the debit memorandum for a not sufficient fund. So, obviously, in the case of a debit memorandum of a not sufficient fund, we have just now seen that it has to be deducted from the balance per books, that is, per books, that is in the company books. Then then a credit memorandum for a note collected by the bank. So in this case, it must be added to the bank to the balance as per the books. Then outstanding checks and outstanding checks, they should be deducted from the balance per bank, sorry, deducted from the balance per bank. And a deposit in transit, they should be added to the balance per bank. Okay. Next, let us talk about reporting cash. Now, the income statement, it shows revenues and expenses but doesn't directly show cash movements. However, the net income affects cash indirectly by impacting retained earnings. The statement of retained earnings reflect changes in retained earnings influenced by net income, but it doesn't detail cash flows. While the balance sheet lists cash as a current asset, giving a snapshot of cash as a single moment. It doesn't explain cash movements over time. But the statement of cash flows, it breaks down cash inflows and outflows from operating, investing, and financing activities, providing a clear picture of cash movements. It reveals where cash comes from and how it is used, offering valuable insights for analysis. Cash is reported in both the balance sheet and the statement of cash flows. Balance sheet shows the amount of cash available at a specific point in time, while a statement of cash flows reveals where cash comes from and how it is used over a period of time. Cash includes coins, currency, checks, money orders, and money held in hand or deposited in a bank. Cash on hand or cash in banks and petty cash are often combined and reported simply as cash. It is the most liquid asset and is listed first in the current assets section of the balance sheet. Many companies use cash and cash equivalents to report cash. Cash equivalents are short term, highly liquid investments that are easily convertible to cash and maintain a stable market value. A negative cash balance should be rare and reported as a current liability. Restricted cash earmarked for specific purposes should be reported separately on the balance sheet. If it's expected to be used within a year, it's a current asset, otherwise it is a non-current asset. You can see over here we are reporting restricted cash with the current assets because maybe it is going to be used within a current year. Then managing and monitoring cash is crucial for companies. Many struggle not because they lack sales, but because they can't handle their cash effectively. Balancing cash flow during the operating cycle is a major challenge for businesses. To ensure they have enough cash, companies can follow these basic principles of cash management, that is, encourage prompt payment from customers, but be careful not to upset them. Offering discounts for early payment can help. Then, large inventories tie up cash and space, so reduce inventory levels to save cash. Then pay bills on time to maintain good relationships with suppliers and avoid damaging credit. Then plan major expenses to coincide with periods of excess cash like the off season to improve chances of getting outside financing if needed. And finally, don't let cash sit idle. Invest it even if only temporarily. Prefer liquid, risk free investments. Next, let us talk about a cash budget. It is a crucial tool for managing cash flow. It typically includes three main sections. There is cash receipts. It is anticipated income from various sources like sales, customer payments, interest, dividends, and proceeds from sales from asset sales. Then cash disbursements, that is expected expenses such as inventory, labor, overhead, operating cost, taxes, dividends, investments, and asset purchases. And then finally, financing details expected borrowing and repayment of loans, including interest. By forecasting cash flows, a cash budget helps in effective cash management, indicating when additional financing might be needed or when excess cash is available for investment. Next, let us talk about petty cash. A petty cash fund is money set aside for paying small expenses. Businesses use petty cash funds for convenience, efficiency, and flexibility. Employees can quickly access funds for small purchases without frequent check writing. Instances where petty cash might be used include purchasing office supplies, reimbursing employees for small expenses, or buying refreshments for meetings. To control petty cash, the company can set a fixed fund amount and designate a custodian. It may require reimbursement request with receipts for all expenses, limit access to authorized personnel and document withdrawals, reconcile the fund regularly to ensure accuracy, segregate duties to prevent fraud and maintain an audit trail for all transactions. So these measures help manage petty cash effectively while minimizing the risk of misuse. Operating the petty cash fund involves three main steps: establishing the fund, making payments for it, and replenishing it. So, when establishing the fund, choose someone to be responsible for the petty cash, decide on the amount needed, usually covering expenses for 3 to 4 weeks. When establishing the fund, a check is issued to the petty cash custodian for the specified amount. For example, if Lloyd Company decides to establish a $100 fund on March 1, the entry is petty cash is debit and cash is credit to establish a petty cash fund. The check is then cashed and the proceeds are placed in a locked petty cash box or drawer. Then, for making payments from the fund, from the petty cash fund, the custodian can make payments following management policies. Receipts are kept in the petty cash box until replenished. The total of receipts plus remaining cash should match the established total. No accounting entry is made until replenishment accounting is done. And then for replenishing the petty cash fund, when cash fund reaches a minimum level, the custodian initiates a reimbursement request. They prepare a schedule of payments made, supported by receipts, and send it to the treasurer's office for approval. Once approved, a check is prepared to restore the fund. Supporting documentation is stamped, paid to prevent duplicate submission. So, now we should keep one thing in mind, that petty cash account is not affected by the reimbursement. Occasionally, In replenishing a petty cash fund, it may be necessary to recognize a cash shortage or overage, and I will explain you in a minute. To illustrate here, like assume that in the preceding example, the custodian has only 12 in cash in the funds plus the receipts. The request for reimbursement would therefore be 88. They have posted expenses, they have supplies expenses, miscellaneous, and uh, the reimbursement is of 88. So if you make the total of the expenses actually incurred is 87. So that it is short of 1, and that's why cash over and short is debit by $1 in this case. Now suppose the petty cash custodian requests a check of 87 and not 88. So now the fund contains 13 cash and petty cash receipts for postage, is 44, supplies is 38, and miscellaneous is 5. So the cash now will be credited by 87, and there will be no cash over and short in this case. So a petty cash fund balance should be replenished at the end of the accounting period, regardless of the cash in the fund. This ensures that the effects of petty cash payments are properly reflected in the financial statements. Internal control over petty cash is strengthened by having a supervisor who conducts supervised counts of the fund, uh, surprise counts of the funds, cancelling or mutilating paid vouchers to prevent them from being resubmitted for reimbursement. So this completes the third video on fraud, internal control, and cash. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.